We need to jump right in. Stitch Fix, that's SFIX, just dropped its Q1 fiscal 26 results, and the management call that followed was pretty telling.
Oh, absolutely. The immediate reaction from the street. I mean, that's the real story here, isn't it?
It's explosive.
Completely. We saw the stock jump significantly higher on really heavy volume. And that tells you investors are seeing this as more than just a beat.
It feels like a turning point.
It's the first real sign that this turnaround story they've been promising might actually be happening.
Exactly. So for a company that's been fighting skepticism for years, this report was a major shot of confidence. So our mission today is to break down those key financials, really dissect the strategy, especially the AI angle.
It's just huge.
And then figure out what the core debate is for the company now that they have this momentum.
Okay, so let's start with the numbers, the ones that got everyone so excited. The top line was a massive win for them.
A beat, right?
A big one. Net revenue came in at $342.1 million. That's an acceleration to 7.3% growth year over year. It just, sailed past what everyone was expecting.
So the growth is definitely real, but growth can be expensive. What about the bottom line, the profitability?
Well, the GAAP loss per share, about 5 cents, was pretty much in line. But the metric that really matters here, Adjusted EBITDA, that was the big surprise.
How so?
They posted $13.4 million. That's a 3.9% margin. It completely blew past expectations and, it showed that the business model is still strong, even with all the spending.
And that kind of result, that combination, gives management cover to really raise the bar for the rest of the year.
It does. They lifted the full year guidance for both revenue and Adjusted EBITDA. You should know they're now aiming for something like $1.32 to $1.35 billion in revenue. It's a clear signal that they think Q1 wasn't a fluke.
That sets the table perfectly. So the big question now is, how? How did they pull off 7% growth in this apparel market? I mean, the whole sector is basically flat.
That is the single most important takeaway from the call. Management pointed out that their growth, that 7.3%, just dwarfs the rest of the U.S. apparel market, which grew at maybe, 1%.
So this is pure market share gain.
Demonstrably. They are taking share from someone else, and that's what gets the market to reward you.
And it seems like they're doing it by getting more from the clients they already have. The monetization metrics, that's where the story gets really interesting.
Exactly. 2 key numbers here. First, average order value, or AOV. It was up 9.6%.
Wow.
Yeah, and this is the 9th quarter in a row of AOV growth. It's because people are keeping more items in their fix, and the assortment is just, it's better.
Which leads right to the big one. Revenue per active client? RPAC.
RPAC hit $559. That's up over 5% year over year. And it's the 7th straight quarter of growth. It's like a flywheel, it just confirms they're getting a bigger piece of your closet year after year.
But here's the tension, right? Here analysts are debating. This growth didn't come for free. We saw gross margins get squeezed.
Yeah, that's the trade-off. They definitely invested for this growth. Gross margin was 43.6%, so down about 180 basis points.
So what's driving that pressure?
Management was actually pretty transparent about it. They gave 2 main reasons. First is just, higher shipping costs from USPS and others. That's a headwind for everyone.
And the second one is the strategic piece.
Precisely. They are deliberately investing in newer categories that have lower margins right now. Think footwear. Footwear has a lower margin than a sweater, but they're betting it drives a much higher lifetime value. So they're trading a little bit of margin today for a stickier customer tomorrow.
It's the classic LTV play. So they're spending on product mix, and they're also spending on advertising. Ad spend was up near the top of their range, almost 10% of revenue.
It was, but they're arguing that spend is worth it because the unit economics are improving. The LTV of new clients specifically has gotten better for 9 quarters straight. It's at a 3-year high.
So they're paying up, but for a better quality customer.
That's the argument, a customer who sticks around and spends more.
Okay, speaking of customers, let's talk about the biggest issue for this company. The shrinking client base. The active client count ended at 2.3 million. Still down year over year, but the bleeding seems to have stopped.
Stabilization, that's the word. The sequential loss was only 2,000 clients. I mean, that's basically 0. This is the 6th quarter in a row that the rate of decline has improved.
And they gave a specific target for the turnaround, didn't they?
They did. They reiterated that their goal is to get back to positive sequential net client adds by the 3rd quarter of this fiscal year. Q3 is now the date everyone has circled on their calendar.
What gives them the confidence they can actually hit that?
Well, besides that improving LTV, they pointed to two things. First, the men's business is already back to growing its active client base sequentially.
Oh, interesting.
And second, the number of dormant clients, people who hadn't bought in a while, was the lowest it's been in 5 years. So retention is getting much, much better.
And we should probably talk about what people are actually buying, because the product trends they call out were, frankly, kind of amazing.
The numbers are wild. In women's, seasonal stuff like coats and jackets were strong, but the trend categories, get this, wide leg denim was up 217%.
217%. Well, that's it. The skinny jean is officially dead.
It's definitive proof. And it shows their algorithm isn't just selling old inventory. It's spotting these big macro trends and capitalizing on them faster than anyone else.
And it's happening in men's too, I assume.
Yep. Second straight quarter of double-digit growth in what they call elevated everyday styles. Athleisure, fleece, outerwear, all of it is flying.
And all this product expansion is what's behind that huge wallet share number they talked about.
It's massive. They estimate that just within their existing client base, there's about a $1 billion incremental revenue opportunity if they can capture their fair share of non-apparel spending.
$1 billion just sitting there with clients who already know and trust them.
Exactly. It's revenue that's just waiting to be captured.
Okay, so let's shift to the engine behind all of this. The AI management basically framed this as their secret weapon, their moat.
It's completely central to their pitch. They've been gathering this unique styling data for, almost 15 years? Their whole model is this hybrid of AI plus an actual human stylist. The human refines the AI's picks, and the AI lets the human operate at a massive scale.
And now they're rolling out some really cool client-facing Gen AI tools.
Yeah, the two big ones are pretty incredible. First is called Vision. It's a generative AI tool where you can see a personalized, shoppable image of yourself wearing the clothes.
Oh, wow.
Right. And the key insight is that this is driving direct sales, but it's also driving organic social media sharing. People are posting these images. It's essentially viral free marketing.
That is smart. Very smart. What about the other one? The one that helps the stylists?
That's the AI Style Assistant. It uses Gen AI to have a conversation with you to help you tell your stylist exactly what you want. So instead of just saying, I need a new outfit, you can say, I'm going to a casual outdoor wedding, it might be chilly, and I don't want to wear a dress.
So it translates vague human request into a perfect brief for the stylist.
Precisely, which makes the stylist way more efficient and makes it much more likely you'll love what you get.
And this AI isn't just on the front end, right? It's all over the business.
Oh yeah, enterprise-wide. The merchandising team uses it for product development, trend forecasting, managing inventory, even for pricing. It's about having the right product in the right size at the right price, which is, the holy grail of retail.
So let's put it all together for the investor. The company is clearly choosing growth and market share over maximizing margin in the short term. They're spending to get there.
That is the tightrope they are walking. They have to deliver on their promise to stay free cash flow positive for the year, while also proving that this margin pressure is temporary and justified by better long-term economics.
The market gave them credit for Q1. But now the pressure's on to deliver again.
The bar is much higher now. They have to execute.
So what are the immediate catalysts? What are the next, say, 3 things we need to be watching for?
Okay, number 1, they have to deliver Q2 results inside that new higher guidance. No excuses.
Right.
Number 2, the big one. We need to see that positive sequential net client growth in Q3. That's the inflection point. And number 3, we need to see gross margins start to stabilize or even tick up to prove this investment phase has a clear end.
Perfect. Okay, before we wrap, it's time for our This Is Not Financial Advice segment. We put on our hedge fund analyst hats and pitch an outrageous but plausible trade idea.
And the setup here is just perfect for this. You have a huge, volatile, positive move in the stock. The turnaround story now has believers. But the next big catalyst, that Q3 client number, is months away.
And the options are expensive because of all that volatility.
Exactly. Implied volatility is really high. So buying a simple call option is pricey and risky.
So what's the pitch? How do you play the obvious bullish momentum without taking on all that binary risk from the Q3 report?
The pitch is to use a defined risk options structure. Specifically, you buy a short-dated, slightly out-of-the-money call spread. You're basically betting that the good news flow, the AOV growth, the AI adoption, keeps the pressure on the shorts and lets the stock drift higher into the Q2 report.
So it's a bet on the positive narrative continuing, but you limit your risk and you're not solely dependent on them hitting that big Q3 number.
Exactly. It captures the momentum while mitigating the all-or-nothing risk of that one future data point.
A great way to frame it, but we have to be crystal clear. This is just speculative commentary. It is not personalized financial advice. Please always consult your own financial advisor.
Absolutely. Know your own risk tolerance.
So to wrap this all up, the key takeaway from our deep dive is that Stitch Fix has managed to change its story. It's no longer about managing a slow decline. It's now a story about data-led, AI-powered growth.
The Q1 numbers prove they're playing offense again, and in a really tough retail market.
Right. And the final thought, the core question we want to leave you with for fiscal 26 is this. If they can actually capture a big chunk of that $1 billion opportunity in non-apparel, can they lift their gross margins back up as those new categories mature while also hitting that client growth target in Q3?
If they can do both of those things at the same time, it's a whole new ballgame for the stock.
That's the balancing act that makes this such a fascinating story to follow. Thanks for diving in with us. We definitely invite you to keep following SFX as they get closer to that critical Q3 inflection point.